Yeah, and I think I've tilted to now more bearish than you on this. I'm kind of also looking at 2008, and if you remember, inflation was at 6%,
Yeah.
oil price was at 140, and the Fed had been cutting for 6 months into that, which was quite extraordinary. But I kind of feel like we're pretty close to the Fed pivot, just because of how monetary conditions have tightened and what's been happening. I don't think we're there yet, but we're kind of much closer than people imagine.
Macro guru and Real Vision CEO Raoul is making a prediction about a massive wipeout of wealth that he says could bring drastic change to the financial landscape. Raoul recently told his Twitter followers that the current economic slowdown will likely result in an economic contraction back to pre-COVID levels. The former Goldman Sachs executive says that baby boomers, who hold the largest amount of wealth in the US, face limited choices in dealing with a potential recession. Hello and welcome to Money Talks. In today's video, Raoul updates about the current situation of the global economy, crashing markets, and high inflation leading to volatility and price action. He also talks about the global economy structure and how the next decade plays out are very different from those of most observers. Make sure to stick around to the end of this video where Raoul shares why the 1970s analog is the wrong one to look at, and that the post-war decades of 1940s and 50s provide a better framework.
Yeah, that's kind of, I think it feels baked in the cake. I had the same view as you that it's going to be a growth shock. And then now I'm thinking actually the financial tightening from not only the rate of increase of rates, but also because of the cost of living, the rise in commodity prices and all of the other, and the rise of the dollar is like, feels like it's pretty baked in the cake here now. But I'm feeling that maybe it comes faster and lasts less. So it's that idea that you had that we're still kind of, it's like the rubber ball's been bounced off the roof, dropped, and we get these sharp oscillations in the economy and the inflation cycle for a while.
Macro investor Raoul is taking the recent market downturn as an opportunity to add to his crypto positions. Raoul recently told his Twitter followers that we are in a buy zone for Bitcoin, adding he's getting ready to significantly add to his crypto positions, probably starting next week and into July. The former Goldman Sachs executive explained that imminent Bitcoin bottom can also be signaled by the weekly relative strength index.
But has the bond market not just done the tightening anyway? It's like we didn't need the central bank. The 2-year rate of change of 2-year yields everywhere has been one of the fastest in history. They kind of did the tightening and the Fed have done basically nothing. I mean, none of the central banks have. Yeah, I mean, I don't know if you've read or are a fan of the book, The Fourth Turning, but that's basically the whole premise as well, that the demographic structural shift is almost a replay of that whole period. And it feels to me that, okay, the big problem the world has got, one of the big problems is the debt levels. Well, we had the same in the 40s, but we had negative real rates for an extended period of time and growth. So therefore, debt to GDP levels came down. I think that is possibly doable this time around. Yes, we don't have as big a demographic push. We're talking about the massive change of supply chains. So people bring factories back to the United States. Sure, they don't employ people because they employ robots, but it's productivity gains and will bring capital back. Same with the ESG. I mean, Europe is going to get rid of fossil fuels.
Yeah.
I mean, which is an extraordinary statement, and they will take some pain to do it.
Yeah.
But that kind of investment plus defense spend, that's a big deal for Europe.
Raoul says that for the boomers, the choices are destroyed pension value or inflation eroded annual pension payments, or QE, quantitative easing to infinity. And that leads to more debts for those with low pensions or savings to offset this, which leads to the need to debase debt via QE. And that screws anyone younger who just get poorer in asset purchasing terms. Assets are just future delayed consumption.
One of the things I've been thinking through is I get the commodity story. I mean, stuff like copper is once we get out of this slow growth, the copper supply situation is very clear and the demand situation. I'm thinking there's actually a barbell here, that potentially it's both growth plus inflation, because the technological growth period we're going through now is extraordinary. And that doesn't stop. So it still becomes very investable. Whether the market discounts it somewhat by a higher rate of inflation kind of gets offset by the rapid exponential rate of growth. But the technological growth period is extraordinary. And that doesn't stop. So it still becomes very investable. Whether the market discounts it somewhat by a higher rate of inflation kind of gets offset by the rapid exponential rate of growth. But the technological growth period is extraordinary. So it feels like for once a barbell strategy might work as opposed to an either-or strategy.
Ultimately, he thinks 20 years of negative interest rates are on the table as they create room for debt reduction and the rise of asset prices. Last month, the macro expert said that even though there's still maybe more pain to come, he thinks that Bitcoin and crypto markets are in a long-term opportunity zone. But can things get worse? Absolutely. But for my investment framework, we are in the buy zone, right near the 2 standard deviation logarithmic regression channel.
So if we're looking over the next decade, this period where we've probably got stronger nominal growth, what is the trend rate of inflation and what is the underlying interest rate, whether it's the Fed funds rate or whatever we're looking at? I just want to try and get the picture of, okay, are we negative real rates? Are we positive? What is the inflation? What does that structure look like that people should think about? Which is very different because people either think inflation or deflation, but what you're saying is there's actually a different structure here.
I'm calling this the tangible 20s. So we had a decade where it was intangible assets that went through the roof, particularly growth stocks. You had this constant re-rating of growth stocks on the basis of zero interest rates forever. We're now getting into a world where interest rates will be higher, inflation will be higher. And so I think that as an investor, you want exposure to the real economy for all the reasons that you said. So you've got a housing boom, you've got the reconfiguration of global supply chains, which means that existing equity holders get hosed, but you're creating new product lines, new supply chains, new value. You're looking at, very strong commodities. You're looking at, big investment in green technologies. So all of those things start to push interest rates higher. My guess is that inflation isn't ever going to come back down to 2%. It may come down very briefly to 2%, but we're not going to be living in a world where inflation is constantly at 2 or below 2. We're going to be living in a world where inflation is constantly threatening to push above 2. And my guess would be interest rates will probably be, the inflation will probably be about 100 basis points higher, just because that's about the number that you get from looking at the impact of globalization over the last decade. So if we're reversing globalization. But I think the big story as well is going to be volatility of inflation. So, not only was inflation low over the last 20 years, but it's very, very stable and hardly moved. All of these forces that we're talking about going forward are going to add a lot of volatility to inflation. So think about climate change. You have the transition itself, which is going to be very volatile. We've seen that over the past 6 months because new green technologies are quite intermittent, so their supply comes and goes. So you get a lot of volatility from inflation on that side, but also the actual impact of climate change, which is going to be more physical supply disruption to the world economy, more shortages of food, and so that's going to create a lot of volatility, inflation too. So on average, I think inflation is going to be higher, but it's going to be a lot more volatile. So we're going to have a lot more periods where you get transitory inflation. And again, the 1940s, 1950s, same story. You see the volatility. You don't get the spiraling of inflation, but you see the volatility in inflation.
The former Goldman Sachs executive says 2 indicators are strongly suggesting that a reversal or at least a bottom is near for Bitcoin. He brings up the Relative Strength Index, RSI, and the D-Mark indicator, which uses a mathematical formula to identify inflection points in price.
But it kind of makes the assumption that technology and growth stocks don't do well. Or do you think that they both do well? My thesis is they both do well. But you're suggesting it's autumn.
At the moment, I think we're adjusting to a higher interest rate world. So you basically had this huge bubble over the past 2 years in everything. And, growth stocks were a big part of that. And this view that interest rates were never going to go up and secular stagnation would probably get worse during COVID. Those are all kind of consensus views up until quite recently. And that led to this constant re-rating of those stocks. And we've now had this massive readjustment, a massive rotation in financial markets. So we're starting to get back to where we were before the pandemic. That you look at the PE ratio of the tech stock, it's basically back to where it was pre-COVID. That to me looks like a quite healthy environment. Those tech companies will still generate the profits that people are expecting, but they're not going to be continuously re-rated on the basis of very low interest rates.
So what are your thoughts about volatility in the global markets right now? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video, and thanks for watching.